Hi everybody, I just thought I would do a short little video about the main differences between defined benefit and defined contribution pensions, because it's something we get asked about quite a lot. So to start with defined benefit, these used to be known as final salary schemes, and to be honest, if you still have one, you are one of the lucky few, even more so if you are an active member. So you're still accruing pension benefits within one. A final salary or defined benefit pension is effectively a promise by your employer to pay you in retirement a percentage of your earnings and your final salary whilst you were working for them. So there is also something called a career average earnings, which is a more modern type of defined benefit pension and replaced a lot of final salary schemes, particularly in the public sector. So if you work for the NHS or you're a teacher, you will have potentially historically had a final salary pension, but that will have closed and you will now have a tranche in their career average earnings scheme. So the final salary is the more generous of the two, and you don't accrue a pension fund as such. What happens is the contributions that go into it, both from you and your employer, are effectively there to meet a promise to you in retirement. So regardless of the underlying performance of your investments, regardless of the underlying performance of the scheme, the employer is required under the terms of the scheme to meet those income payments to you when you retire. So they normally have a set, what we call normal retirement date, which can be any age, generally from 60, some are 65, and the public sector, so the teachers and the NHS scheme now more commonly are actually linked to state pension age, so it could be as high as 67 or 68. For those of you who are in them, when you get to your retirement date, you will be entitled to take a lump sum, normally up front, and you will also then get an annual income paid for your life. Now that annual income is index linked, so there will normally be increases applied by the scheme, and they're different, they vary from scheme to scheme. So always have a look at your paperwork to see what annual increases you're likely to get in retirement. But because of that index linking, that inflation proofing, they're a very, very valuable income source in retirement. Far more valuable, which I'll come on to in a minute, than the income that's likely to be paid to most individuals from a sort of defined contribution or personal pension arrangement. So broadly speaking, you can look to potentially transfer your final salary benefits. However, we generally suggest that clients don't because of the values that are held within them, except in a few particular circumstances. Ill health can be a driver for some people to look to transfer out of a final salary or defined benefit pension into a personal arrangement. However, there are significant risks in doing so. So we would always suggest that people took appropriate advice. In fact, you're required by law to take appropriate advice before the trustees will allow you to transfer out, where the scheme benefits have a transfer value of greater than £30,000, which most will, with the exception of very, very small deferred pensions. So in terms of what happens when you die, a final salary pension will provide spouses benefits, and they're normally 50% of the income that's payable to the main member, and that will be payable for the spouse's life. Some schemes are slightly more generous and offer a 2/3 widow's pension, but that's generally not the norm. The more common is 50% of the income. After the spouse passes away, so assuming that both the member and their dependent spouse are no longer here, it's unlikely that there'll be any further pension payable to their family members, unless they have dependent children under the age of 21, a few other circumstances where they might have children who are potentially adult but dependent due to illness or other things. So it's very, very limited scope as to whether any further pension will be paid in the event of the death of the member and their spouse, but generally speaking, there won't be anything. In terms of a defined contribution pension, which is likely to be the type of pension that most people will now have, and most employers obviously now offer staff an auto-enrolment scheme as standard under the auto-enrolment requirement set out again by the government. So it's likely that most people will have at least one of these and sometimes multiple pots. A defined contribution pension is whereby a certain amount goes into the pension pot each month. So you effectively pay normally from your salary, but you can have a personal pension arrangement whereby you do the same thing and just pay in a set amount each month. And you can make monthly, annual lump sum contributions, however you want to do it. But effectively what happens is those contributions go in, think of it like a bank account, and they build up over time. You get tax relief on the money as it goes in, your marginal rate. So for basic rate taxpayers, it only costs them 80p to get a pound in the pension pot. And for higher rate taxpayers, because they can get 40% tax relief, it's even more generous. It only actually costs you 60p to get a pound in the pot. There are limits over what you can put in, and there are also limits on the lifetime allowance in terms of what you can accrue over your lifetime before you incur further tax charges. Those apply to both the final salary and the defined contribution scheme. So the lifetime allowance and the annual allowance are relevant in both cases. So going back to defined contribution then, as I say, you'll pay in a amount on a monthly, annual basis, whatever it was set up as. And the fund, the money will be invested in some investment funds. It can go into cash if you prefer, but generally speaking, when we're looking at a very, very long time frame horizon, we don't suggest that people normally hold their investments in cash, because obviously the inflation will eat away at the purchasing power and the value of that over time. So the fund should hopefully be growing for you, but obviously will fluctuate in line with the value of the underlying investments within it. So that's why it's very important that you not only have a look and see how your pension funds are performing, but if you're in any doubt, look to speak to an advisor, because they will be able to give you some guidance over what you have and whether it's at an appropriate level of risk for you, because everybody is different. The fund will fluctuate, as I say, and when you ultimately get to retirement, you will have built up a pot. Now, rather than the final salary scheme, which offers a fixed income to its members in retirement, the income that you take from a defined contribution pension can be anything that you like. So, for instance, if you had a pension fund that was valued at £100,000, you could, say, take £4,000 a year via a drawdown arrangement. You could take £10,000 a year if you wish to via a drawdown arrangement, or you could even, if you really wish to, take the whole amount out in one go. Bear in mind though, if you take the whole amount out in one go, you'll be paying an awful lot of tax. So I would never suggest that clients consider that. And equally, if you were to take £10,000 per annum from a £100,000 pot, then you would find that very quickly your funds would deplete and that eventually the pot would run out. So sustainability on a defined contribution pension is very, very important, and it's a big part of what we look at with clients on an ongoing basis. There are different options for people when they get to retirement. On a personal defined contribution pension, you can take the pension at any age, currently from 55. On a defined benefit pension, as I say, the scheme age is set by the scheme administrators. They will often allow you to take the pension early, but they reduce the amount of income down that they will give you in line with the fact that they'll be giving it to you for longer. On a personal pension or defined contribution pension, you can set your retirement age at any age you wish from the age of 55, and you can draw any amount of income that you wish from the age of 55. You can also take 25% of the value of the pot out tax-free. So for instance, if you're looking again at the example of a pension that's valued at £100,000, you could take out 25% of that tax-free at outset. We find that sometimes clients look to do this because they maybe have some residual mortgage that they wish to pay off, or they wish to go on a world retirement cruise, or potentially replace their kitchen or some other home improvements before they retire. If you take the tax-free cash from a defined contribution pension, you do not need to take any taxable income. So you can take 25% out that you're allowed to tax-free without taking any further benefits from the pension at that time. If you do take taxable income at that time, then you are then limited on the amount that you can put into pensions in future years. So again, it's always something to seek advice about before you start taking retirement income. You can also take pension income from defined contribution and defined benefit pension, potentially whilst you're still working. Defined benefit pension, generally most employers, as I say, don't offer them currently. So it's likely to be historical schemes that you hold for an employment where you no longer are. So there's no reason why you can't take that pension and work beyond the normal retirement age for your new employer. There's no reason why at all. Likewise, on a defined contribution pension, you can start drawing an income from the pension scheme whilst you're still working, should you wish to. But bear in mind tax, and we always say to people, be mindful of what tax you're giving to the government. So always make sure that you get advice again about the amounts that you can draw within the various tax allowances. In terms of what happens in the unfortunate event of death, again, it depends within a defined contribution pension over how you've decided to take benefits at retirement. If, like a lot of people now, you've decided to go for income drawdown, whereby the fund stays invested for your whole retirement and you take an income that can be set at any level you wish for over that retirement, then the fund can pass to your beneficiaries, and it's separate to your will, so you would need to ensure that a separate nomination of beneficiary form is completed on the pension scheme. And your beneficiaries can be anyone. They can be your wife, spouse, husband. They can be a charity, should you wish. They can be children. Just bear in mind, if you choose to leave it to anyone other than your dependent, and you do have a dependent, such as dependent children or spouse, then the scheme administrators can, or scheme trustees can actually decide to provide the benefits to your spouse instead, rather than the person or the charity that you've nominated. So how does it work? If you die before the age of 75, then, which statistically is very unlikely, but some people obviously do, then the entire pension fund can pass to your nominated beneficiary completely free of any tax. So it sits outside of your tax-free estate for inheritance tax, and they can access that pension fund. They can take the whole amount out should they wish to, tax-free. Again, if they don't need it, so if it's for a spouse, but actually they have other income in their own right and don't actually require any income from the pension fund, they can then select a new nomination, and if anything happens to them, that would pass to their nominated beneficiary. If, which is more likely, somebody passes away beyond 75, so after the age of 75, then what happens, the tax treatment is slightly different, and again it passes outside of the will via the nomination of beneficiary form to the nominated beneficiary. And that can be more than one person, by the way, so it can be, you can split your beneficiary to, you know, you've got multiple children or multiple people who you wish to benefit, you can nominate different people. It can also go into a trust as well, so if you have potentially children from a previous marriage and you wish to ensure that they are likely to ultimately benefit, but you also wish for your spouse to benefit, then you can elect the payment to go into a trust. And under the rules of the trust, you can set out and specify that your spouse receives an income for life, but then on their death, rather than the funds going by their nominated beneficiary to their nominated beneficiary, they go to the children or whoever you set out in terms of the trust. So that's something we do quite regularly for clients as well. But if you die beyond 75, then the beneficiaries will pay tax on anything that they withdraw from the pension at their own marginal rate of income tax. So for argument's sake, if you know, the pension is worth £100,000 and they inherit it, if they just leave it in the pension and they don't require it at that point because maybe they're working and they're not yet retired, then they wouldn't pay anything at the point that they inherited that fund. If they then decided to take the whole lot out in one go, that £100,000 would be added to their own other income and taxed accordingly. So we always suggest that if an individual you know, does look to leave pension funds to children or grandchildren, that they suggest to those children and grandchildren that they're aware and that they seek advice over how they look to withdraw the funds, because again, if they can be done in a way whereby it preserves as much of the fund in a tax efficient manner, it's a sensible way of doing it. So in a nutshell, that's a broad rundown of the differences between the two types of pension. Obviously, as I say, it's much more common now for people to have defined contribution pensions, although there are still plenty of people out there who have legacy benefits under the old final salary or defined benefit arrangements. If you're unsure of what you have, always seek advice. Most advisors will offer an initial consultation with clients, which is completely free of charge and which comes with no obligation. Fiducia are a firm who do that, so please feel free to contact us if you're ever unsure of what you hold, and also if you're ever unsure as to what options you have with it in retirement. Thank you. Bye.